The year was 1910 when 6 men set sail for Jekyll Island with one mission: to reform nation's banking system. The meeting and its purpose were closely guarded secrets, and participants did not admit that the meeting occurred until the 1930s. But the plan written on Jekyll Island laid a foundation for what would eventually be the Federal Reserve System. Just before Thanksgiving in 1910, US Senator Nelson Aldrich invited 6 members of America's banking elite to a covert retreat on Jekyll Island. The group included Aldrich, his private secretary Arthur Shelton, Davison, Andrew, Frank Vanderlip, president of National City Bank, and a former treasury official, and Warburg. This was before the first transcontinental call was placed. At the time, the men who met on Jekyll Island believed the banking system suffered from serious problems. Like many Americans, they were concerned with financial panics, which had disrupted economic activity in the United States periodically during the 19th century. Nationwide panics occurred on average every 15 years. These panics forced financial institutions to suspend operations, triggering long and deep recessions. American banks held large required reserves of cash. These deposits were spread across the nation. These were held in the vaults or as financial deposits in the institutions. During crisis, they became frozen in place, while in booms, banks' excess reserves tended to flow toward big cities, especially New York, where bankers invested them in call loans. This American system made bank reserves immobile and equity markets volatile, a recipe for financial instability. In Europe, in contrast, bankers invested much of their portfolio in short-term loans to manufacturers and merchants. This commercial paper directly financed commerce and industry while providing banks with assets that could quickly convert to cash during a crisis. The Jekyll Island participants also worried about the inelastic supply of currency in the United States. The value of the dollar was linked to gold, and the quantity of currency available was linked to the supply of a special series of federal government bonds. The supply of currency neither expanded nor contracted during the seasonal changes when cash was in demand. American banks could not operate overseas. Thus, American merchants had to finance imports and exports through financial houses in Europe, principally London. American banks also struggled to collectively clear checks outside the boundaries of a single city. Aldrich and his colleagues quickly realized that while they agreed on establishing elastic currencies supplied by the bank that held all the reserves, they disagreed on the details. At Jekyll Island, Aldrich and his team proposed the Reserve Association of America, a central bank with 15 regional branches. Each branch, governed by directors elected by member banks, would hold reserves, issue currency, clear checks, and manage transfers. The national body would set discount rates and handle securities. A final report went to Congress next year with a few minor changes, including naming the new institution as National Reserve Association. The commission said it had created an institution scientific in its method and democratic in its control. But many people, especially Democrats, objected and it was shelved. However, when Woodrow Wilson won the presidency and the Democrats took control, they were interested in reform. Wilson's chief political advisor, Colonel E.M. House, met and corresponded with Warburg to discuss banking reform in general and the Glass and Owen plans in particular. Henry Morgenthau, a senior political advisor to Wilson, met and assured Warburg that he sent his copy of memorandum to President Wilson. Together, these ideas formed the basis of the final Federal Reserve Act, which Congress passed and the President signed in December 1930. The technical details of the final bill closely resembled those of the Aldrich Plan.